Why is there economic inequality in the Eurozone? Imagine a group of countries sharing a single currency but having very different economic realities. That's what the Eurozone is all about. It's a union of countries that use the euro, but they don't all experience the same wealth or growth. This setup has created some big differences in income, employment, and public services across the region. So, why does this happen? Let's break it down. When the euro was introduced, all member countries agreed to a common monetary policy managed by the European Central Bank. That means interest rates and money supply were set for the entire zone, not for each country. Countries like Germany, which had strong economies, low inflation, and good growth, faced higher real interest rates. Meanwhile, countries like Spain and Greece with weaker economies experienced artificially low interest rates. This made borrowing cheaper for them, leading to more debt and bigger private and public debts. Because they shared the euro, these countries couldn't devalue their currencies to make their exports cheaper and more competitive. Normally, a country in trouble might lower its currency's value to boost exports, but that wasn't an option here. As a result, countries like Greece and Spain faced trade deficits and rising debts, which widened economic gaps within the Eurozone. Another piece of the puzzle is how each country manages its own budget. While the European Central Bank controls monetary policy, each country handles its own taxes and government spending. This mismatch made it tricky to fix economic problems. Countries with weaker economies often had to impose austerity measures, cutting public spending and social programs. That made inequality worse because fewer resources were available for health, education, and social support. Institutional differences also matter. Some countries have strong wage-setting systems and innovation sectors that help grow incomes. Others, especially in Southern Europe, have weaker institutions and less competitive industries. This means some countries grow faster and share wealth more evenly, while others fall behind. Global trends have added to these issues. Capital tends to flow into stronger economies, leaving weaker ones struggling with money leaving their borders. Over time, wages in many countries have declined as trade unions weaken, and income inequality within countries has increased. The Eurozone crisis from 2008 to 2012 made these problems clear. Countries with high debts and trade imbalances faced severe economic downturns. Because they couldn't adjust their currencies, they had to rely on austerity and bailouts. This led to higher unemployment and more social inequality, especially in the southern countries. In real life, this inequality shows up as differences in pay, job opportunities, and public services between the north and south of Europe. It also affects how people see the European Union and the euro. Many in the more affected countries feel the system favors the stronger economies. So, the main reason for economic inequality in the Eurozone is how it was built. The shared currency and centralized monetary policy limit what individual countries can do. Coupled with pre-existing economic differences, weak institutions, and global financial trends, these factors have created persistent gaps that are hard to close, especially during tough economic times.